So can do these private equity firms when they're pitching or they're starting like a vintage, like you said,
Mhm.
um, with such a long horizon and not knowing, maybe they don't know what opportunities they're actually going to come across in that period.
Mm, right.
How do they market it as far as like an expected rate of return, and then also also to that point, at the end of this term, do institutional investors then benchmark just to other private equity firms during that period? Is that common?
Yeah, so in terms of the marketing, for firms that are new at launching a fund, it's really just, hey, here's our background. Here's where we've worked before. We've had successes at those firms. They might be able to, call on some prior performance of the prior firms they worked at,
Mm.
but really it's a promise at the end of the day. And so what they'll typically say is, here's our target return, right? We have a hurdle rate of return of 30%, right? That's something you typically hear, particularly in venture capital, it'll be sort of like 35%. Your typical buyout fund might be sort of 20%, right? Or it might be relative to some market multiple, right? The S&P 500 plus 5% or something like that
Okay.
over the full business cycle, like 10 years, right? On an annualized basis, right? That's the typical, pitch in
Mm.
terms of raising funds. For larger private equity firms who already have a history of success, it's much, much easier for them to raise funds.
Hmm.
And, there's academic research that suggests that that's not an accident. They actually tend to outperform over time, right? That is to say, those private equity managers who have outperformed in the past, there is performance persistence in the private equity realm, right? That is, they continue to perform well in the future, which is not the case in public markets, right? Your typical mutual fund, there's really no, predictive ability
Mm.
based on past performance.
Gotcha.
Um, yeah. So there was a second part of your question and it just slipped my mind
Oh,
now.
the so at the end here, how does an institutional investor sort of figure out we did well, or like how we did at, you
Oh
know what I
yeah, the
mean?
benchmarking,
Yeah.
the performance measurement. So you mentioned this term earlier, internal rate of return, IRR.
Mhm.
So this is a form of return measurement, which is very different in many ways than what we think of in terms of public markets, right? So in public markets, we look at we call them returns, right? And it's really technically what's called a dollar weighted return, right? How much money I put in, got some returns, I pull my money out. Internal rate of return is a time weighted return. It's sort of a function of how much did I earn over what period of time, right? So in some ways, it's kind of like your speedometer in your car, right?
Mhm.
I'm doing 60 miles per hour. I'm getting 20% per year, and I've been in it for 5 years, right? So it's a 5 year return, right?
Right.
The problem with that measure is that over as your time period extends, the IRR falls if there's no more cash flows, right?
Mhm.
Which might seem obvious, but oftentimes when firms are raising capital for a new fund, they typically raise it in the middle, right, of the life cycle of their current fund.
Hmm.
So the returns look pretty good.
I
But
see.
that can drag on forever, getting rid of those last, laggard firms that they can't sell in the portfolio, right? And so the
Right.
IRR could be dragged down over time from that. But there's other ways of measuring private equity performance. They typically also report something called multiples of invested capital. And there's a
Mhm.
couple other acronyms in there. But basically, the idea is, how much did I put in? $10 million. Dollars. And how much did I get out at the end? $20 million. Dollars. So I have a
Right.
2x multiple, right?
Right.
And clearly that'll change over time as well. So early in the years, you have a negative multiple because you're not getting any cash flow. And then over time, that becomes more positive. And your goal, of course, is to be well north of one, right? You want,
Right.
a rate of return well north of one, particularly on an annualized basis.
Mm.
In terms of benchmarking, right? How does the Hawaii employee retirement system benchmark their private equity investments, right? Um, at least formally, typically what they'll do is something called a public market equivalent, right? So this is born out of some research in the private equity field 20-ish years ago. In well, 30-ish now these days, I'm getting older. And basically what it does is compare the private equity fund's performance to the public market in a very simple way, right? So remember how I talked about getting those capital calls after you've made that commitment, and they say, "Hey, we found a firm, give us $1 million," and then a year later you get another call. Okay, now we need 5 million. Now imagine instead when you got those capital calls, you put it into the public markets, right? So it's sort of a time equivalent rate of return based on when you're putting money in, except you just, instead of putting it in this private fund, you're going to put it into the public markets. So you can kind of figure that out, right? If I'm getting a call every 6 months, equal $1 million payments over the first 3 years, well, what would be the equivalent if I did that in the public markets, right? Bought a low cost index ETF, for example.
Right.
That's what a public market equivalent it is. And so that's kind of a standard benchmark that we would use. And of course, we're human. We see public markets all the time. So of course, we're also going to look at the S&P 500 plus maybe some liquidity premium. Like, I want to be whatever, 3% above the S&P 500, like at least, mentally. To your other point, though, they will also look at other peer private equity funds, right? So there's, these large commercial data sets where you can see what, other private equity funds are doing in terms of performance. But, it really depends on the sophistication. But in fact, my old firm, Cambridge Associates, produces an index, right? A private equity performance index every quarter, right? So that's also something that investors can use. And other commercial data set providers like Preqin and PitchBook also put out that sort of industry level performance information.
Okay, interesting. And then I guess another thing from the institutional investor perspective, it appears from my vantage point, private equity offers two things. One, there's the potential for higher than market returns, right? Your public market returns.
Indeed.
But then two, I would imagine some of these institutional investors, when they're designing a portfolio, it probably offers a fair amount of diversification in that I would imagine private equity firms, some do better actually when markets go down if they're in the business of maybe acquiring struggling businesses at the bottom. So it might not be correlated. So I'm sure it offers diversification as well, like a two-edged sword there for them.
It does indeed, right? That's exactly, one of the main reasons investors like the asset class is it does provide diversification, which, sometimes it's not always good.
Right.
So
that's a
in terms of performance, but diversification is about correlation risk, right? Not necessarily performance risk.
Right.
So timing's everything.
Point. Yeah.
That's exactly right. And yeah, to your point, private equity has outperformed. Most academic studies show, including ours, that they tend to outperform public market equivalents, as it were, right? But it's really fund by fund specific. If you have access to the top quartile of private equity funds, you can pretty much sleep well at night. But the remainder, it's hit or miss, much like any mutual fund would frankly be. It's not like you're going to lose your shorts necessarily unless you're in the worst one. But you might not get the returns you hope for, depending upon which fund you're invested in.
The opinions and statements presented on this show are for general information only and are not intended to provide specific advice or recommendations. Never make any investment or financial decisions based on information offered on this show without first consulting your financial, legal, or tax advisor. All economic and performance information mentioned on the show is historical in nature and is not indicative of any future results. All indices mentioned on this show are unmanaged and cannot be invested in directly. All information is believed to be from reliable sources. However, we make no representation as to its completeness or accuracy. Lastly, all opinions expressed by Jason Cutitta and any guests on the show are solely their own opinions and do not reflect the opinions of or are endorsed by ToBA Financial. For Jason Cutitta, investment advisory services are offered through ToBA Financial LLC, a registered investment advisor offering advisory services in the state of Hawaii and in other jurisdictions where exempt from registration.